Let me just ask, what if God was one of us? Sorry,
That's
a
great song.
All right, it's just a.
It's a great song.
It's a
You're gonna get
wholly
Mitch singing again.
non-contextual.
You know it. You know it.
Right, wholly not. Well, maybe. I mean, there are a lot of folks probably who listen to this program who have no idea what I just blurted out. But as I told Joel, we saw Joan Osborne here in Steamboat last night with some friends, and so that takes you back to the 80s, doesn't it? I think. Speaking of GE,
80s were awesome, though, Tim.
Right?
I could relive the 80s. Couldn't you relive the 80s? The 80s were fun. Joel would relive the 80s for sure.
Back when everything was awesome. The 80s.
Yeah.
I love the 80s.
The lovely elevator music, we rocked back then.
Good to see you. Happy Monday, guys. Happy market structure Monday.
Happy Monday. Let's.
You didn't have the internet back then, Tim. Got to get rid of the internet
or social media.
Yeah.
So
the world was a better place without social media, though, wasn't it?
Well, it was. I was in Sri Lanka, off the coast of India, in college in 1989, and I communicated with airmail. We would pack. It's like tissue paper, and we would set up our dot matrix printers to pack text in those things and send letters to our friends and family. And that was social media in 1989. And it was awesome.
Well, Tim, you know what they say, right? Do you remember?
Great song.
The good times, baby.
All right. Put you in a good mood, right?
Hey, I always try to turn things around. I mean,
it's not. I don't even understand the music nowadays. Like I put it on, Laura's like, "Oh, listen to this new song." I don't even understand it.
Right.
80s and 90s and 70s, 80s and 90s. Those are the best. That's the best eras.
Oh boy,
70s, 80s.
We're going off the rails here. Okay.
All right. Well, I'll tell you what. There's a lot of negative out there, so maybe you guys remember a little bit more of the bullish tune out there. But let's talk about, of course, the economy, the banks here, real estate. What stocks are rising? Market structure edge. Help us out.
Well, there's a lot of negativity, right? Which is a good reason to go back to the 80s and play. Right.
Let's
celebrate good times.
Going.
Right, if you read Mike Wilson's note from not that you have to do this at all. Morgan Stanley's chief equity strategist, I think he is.
Yeah.
He's one of many who see pretty vicious conditions here. He said he sees a vicious end to the bear market. So. I guess you could take that as good and bad. I don't know. I can certainly give you my. I think I have a good handle on the basics of economics because they underpin edge, supply and demand. They have a good handle on monetary policy, but that's not necessarily how to think about it if you're a trader. If you're a trader, what I think you have to focus on is where the money is going. And if you looked at how the market's been okay. I mean, the broad measures were up, about 1% last week?
Yep, 1.3.
Right?
Bank crisis. We ain't going down.
Right. So
bank crisis is on pause right now.
So why does that occur? That's your central question, Mitch. And so look, I can only tell you what we see in the math, and the reason prices rise is because there's been diverging supply and demand, and I can explain why that occurs. And certainly, as we come to the end of the quarter, the big thing this week will be the end of the first quarter. What is that? That's Friday, right? Friday will be the last trading day of the quarter, the last trading day of the month, and we can talk about that in a moment. But this is what. So I have GE up, by the way. So to me, if you're going to trade GE, trade diverging supply and demand. If demand rises and supply does not keep pace, there's an opportunity. If they converge, leave. Just take your gains. And it really doesn't matter what GE has delivered over the long term. If you take the periods of time when it offers you returns and avoid the times when it doesn't. And I think that the same is true in the market. Do I like that? No, I don't. I mean, I think it would be much better for all of us if the market were a good barometer of economic conditions, but it's not. You cannot look at the market and draw a big conclusion about what the economy is going to do, and here's why. It's because much of the money in the market needs equities as an asset allocation plan. So all the people in their 30s and 40s who have target date funds and 65% of their assets have to go to equities, that money has to get deployed. And the managers doing that aren't sitting around going, well, I wonder if earnings are going to decline. That's not what they think about. A small part of the market, comprising about 9% of trading volume, is doing that. And you can hear Jim Cramer on CNBC, no offense to Jim, like, well, we just focus on companies with great fundamentals, we'll be fine. It's not true.
Yeah.
It's not true unless those companies offer enough product to absorb the part of the money that is allocated to equities. It's the reason why Microsoft and Apple are 13% of the S&P 500. It's because they're very large. So here's why stocks have been rising. Just take communication services. So this is where Meta is, Pinterest, stocks like that. Demand rose and supply fell. It is that simple. So as we came through options expirations, these things had been devalued. And so the people allocating assets looked at them and said, well, there's some pretty good supply of the product there. And they consumed the product. Well, the good news is we can see that. And I'll tell you, it's a lot less work than wading through fundamentals and hoping that earnings or margins or top line growth are going to correlate with how stocks perform. Good luck with that. That's gambling to me. To me, what is not gambling is following supply and demand. And if money goes into equities, then you can. If money leaves equities, you should. And you can see that stuff. And it's that simple.
Yeah, and we're also getting really close to quarter end here, right?
Yes.
How will that be affecting some of this data and where we could see some trades going?
Well, it's very important, traders, to understand that if you're managing index funds and realize that the largest single asset class in the world in equities is what's called passive large cap blend. It's neither growth nor value, but both. Microsoft and Apple are both value and growth, believe it or not. This, in the past roughly 2 weeks, Microsoft has been the growth choice. Apple has been the value choice. And you can see it in the data, by the way. But that is where the money's going to go. And at the end of the quarter, all that money has to be squared with the index. So if you have to be a certain part value, a certain part growth, it's got to get there by March 31st, roughly. Because if you don't, you could get in trouble with regulators. So as we come to the end of the quarter, you want to know, does that mean people are buying equities or selling them? Well, if we look at, this is Benzinga March 27th, today, and it's got 5 components and their value and growth. So if I blend these things and look at the stuff that is telling us where money is going, interestingly, it's got the lead category, lead sector is consumer staples. I'll zoom that in so you can see it. Now, I've only got 5 stocks in here, so it's not a great representation. But look at this, rising demand, falling supply, and it's a blend. Passive money's the lead behavior, just exactly what I'm talking about. All these asset allocators, where are they putting their money? Well, that's what we want to know, so that we can take advantage of where that money goes. It's the best way to produce returns short-term when you're trading, because it is the most reliable, the best central tendency, the highest probability, whatever your aphorism is that you prefer, that's how to look at this. So if I looked at these things right now, I mean, it's kind of telling. I think drinking Dr. Pepper is a pretty good idea because KDP is a great value play, as is Monster Beverage. I don't even know how you pronounce this. Aglion. It's a healthcare play, but it's a great supply-demand divergence. Gold, which is Barrick, that's it. That shows how money is hedged. Nvidia, there's your little growth piece of the puzzle. It's taken the place of a lot of other things, but stuff like that.
These are all playing defense.
They are all playing defense. I agree with you.
And Nvidia, they'll argue with me. It's 40 times earnings. This is not defense. But again, we know we can see the correlations. It's not a bank stock, and they have flocked to Nvidia during this time, saying, "Hey, we've still got chips and everything. Nvidia is still the leader here. Very little debt, if any. I'm not sure. Last time I looked, I mean, they just think that NVIDIA is fine even if we lose the banks. So it is playing defense against the banks. But gold, obviously, defense. Monster Beverage is defensive. Drinking Dr. Pepper is defensive. People drink more Dr. Pepper when they're not feeling good about their portfolios. It's all defense, Tim.
I agree with you. And I remember, Dennis, that you said, I think it was Monday, that if you're going to be someplace, be in large cap tech. That's where the money's going to be. And you were right about that. And in some ways, NVIDIA has become a touchstone for that. And we can look at big tech, but here's why money's going to NVIDIA. And it's right in front of our eyes on the screen. And it's got nothing to do with its fundamentals. It has to do with its liquidity. So if you look at the dollars per trade, which is a great measure of liquidity, for algorithms, an algorithm that is programmed to move a lot of money in many different things at once, what I want to do is how much of that can I move? And if you look at all of these, $23,000 a trade in NVIDIA versus $5,000 in gold. And these are all liquid stocks, by the way. All of these are in the top 500, close to it. Yeah, AGL is about the top 850 in the market for liquidity. They're all very liquid stocks. So big money can get into and out of them. Very difficult to get in and out of the Russell 2000. By the way, here's something to know, traders. There are roughly, if you look at the Wilshire 5000, one of the largest total market indices, there are roughly 1,700 microcaps and 1,300 small caps, and they're 5% of market cap combined. 3,000 stocks are 5% of market cap, which is why they may get arbitraged back to an index level at some point, but they're not good places to be. There are only 500 large cap stocks and 300 mid caps. That stuff comprises almost 90% of all market cap. Maybe it's even more than that, 95%. So realize that's where the BlackRocks, Vanguards, and State Streets of the world are going to go, and Fidelity. So that's really how to think about the market today. Not about, well, what kind of cash flows is somebody producing? It's what kind of size does this block represent, and how does money go into and out of them? And that, the good news is very measurable, traders.
All right, I'm on mute there.
Oh, sorry about that.
Joel's on mute. Go.
No, I'm not on mute. End of quarter, Tim.
Yep. So, money's been going to big tech. By the way, you can look at that very easily. So, we at Edge, we put this portfolio called Big Tech on your desktop, and their passive money has been a key driver. I would look at that and say, well, it's about done. It's about to hit 10. And supply is starting to rise. So the movement into whatever's going to get allocated to big tech, except NVIDIA is still the best of that lot, is about done. I think, would you look at it and say, where is money going to go to value or growth? Dennis already summed it up. All the money really is pretty defensive. And that's a pretty good place to be. So if you want to know, you don't even have to read all the pundits and the commentary. All you have to do is look at the money. Is the money biased toward things that are more aggressive, or is it biased towards things that are not, that are very liquid? And we have our answer. So I would say it will be a value market. Now, if I look at the data, we track momentum and low volatility. I trade those. I'm going to trade stuff in those. And so momentum's got 8 components. That's not great. If you're not double digits, it's not great. So it's not a great momentum market, but you can see where the momentum is. Fast traders, which are the momentum force, are in communication services. That's where it is. And where's low volatility? Passive money, asset allocators are in consumer staples. So if you want to be low volatility, this is interesting, by the way. All 4 of these stocks have exactly the same volatility. That's telling. It's all 1.7, 1.7, 1.7, 1.7. That's all they move intraday. So if if one of these stocks, like Dr. Pepper, is down 2%, I'm buying it because I have a very good chance of making 1.7%. But that's where the money is. So if you want to be safe, be there. And if you want to take chances, and I always say take gains, not chances, trade communication services. That's where the momentum will be for a little bit longer into quarter end.
All right. Like always, you guys can check out Market Structure Edge, throwing up the link here so you guys can check out this platform yourself. You want to get access to the data? Check it out, team. There's the link. And like always, you guys can reach out to Tim to get a little bit more. We'll have you back on, Tim. Appreciate you coming on.
Thank
and enjoy the weather out there. I see a lovely white snow all over the mountains. So
we've had 2 feet of snow in the last roughly 3 days. We're
tears,
well over
tears, Tim. I'm missing Colorado, that's for sure. You have a good one, my friend. Take care.
You too. Thank you. See you guys.
All right, let's take a look into the market as we wrap up and then get to our trade zeros.